welcome. You're watching Your Money Matters here at NDTV Profit. I'm Mahima Vachrajani. Now, over the last few years, investors have kind of poured money into themes, credit, hybrids, as well as tactical strategies. India's mutual fund industry is now going through a kind of reset for a lot of these mutual fund categories and rules. Now, from redefining credit risk to kind of tightening thematic launches and introduction of life cycle funds, SEBI's latest categorization circular kind of just doesn't tweak products, it kind of reshapes how portfolios will be built, marketed, and kind of understood as well. To decode exactly this and what this means for investors like you and me, I'm joined by Radhika Gupta, who's the MD and CEO of Edelweiss Mutual Fund, joining us now. Radhika, thank you so much for taking out the time. My first question to you is from a broader lens perspective, right? This circular coming in, is it more about risk control? Is it more about investor protection? Or is it the next phase that the industry maturity is going to see going forward?
I think the circular has two, I see the beta points of the circular as twofold. One is more focus on schemes being true to label, investor protection, and that is all reflected in how credit funds are classified, the whole overlap around sectoral and thematic funds. I think all of these are steps towards saying arbitrage funds, saying that do what you say and say what you do and be very, very clear about that. And the label should be the actual. So I think that is one lens. The second is I would call a opening up of the market to reflect, or opening up of the category to reflect new realities. So for instance, in many hybrid and equity categories, the residual portion now can be REIT, InvIT, gold, silver, etc. It just doesn't have to be fixed income. There's the introduction of a new life cycle class. So that second part, I would say, is a one-time reopening up of mutual fund categories to give additional flexibility to reflect new capital market realities. These are the two meta themes, I would say, that have come out.
So then, Radhika, I just want to get a sense. Would you put this, as SEBI moving from kind of product proliferation to portfolio discipline? Because I think there are multiple problems that, through this circular that SEBI is trying to solve, which is alpha dilution, mis-selling. There's also category cluttering that is happening. Do you think that reading is correct?
I would say it a little differently. I would say rather than product orientation, more solution orientation. So rather than just having a suite of products, being very, very clear about why individual products exist, what purpose they will solve, as I said, matching the label that they have, and really focused on a solution and need-oriented selling rather than just having products for the sake of products. I actually think the circular, if done right, can lead to a lot of thinking and a lot of innovation also.
Got it. There's also, just talking about, line item wise now, they've also said that you can now run both value and contra funds with a 50% overlap cap. Does that create a genuine style differentiation? Or do you think this is just, kind of branding separation that, they're kind of trying to do? How does it, make this different?
So they've done it in two places. They've done it in the value and contra category. They also used to have either balanced or aggressive hybrid. In the hybrid category, they've said you can run both. But what they've very clearly done is define the amount of overlap. So in value and contra, you can have 50% overlap. Now, theoretically, if you want, value and contra can be run as very different strategies. Value is really picking up peak value companies. Contra is trying to do something that's against market cycles, and those don't have to be traditionally value-oriented companies. So while there can be similarity, if you were to run it differently, I think there can be differences of approaches. The critical thing here is, I think 50% overlap is a very, very good criteria. So that will make sure that you run your value and contra fund differently. Again, the criteria for aggressive hybrid and balanced hybrid is also very, very clear. So that will make sure that you run them with a different risk return profile.
With regards to the limiting of thematic launches to an kind of AMFI notified list is what they've said. Now, this, do you think, is an attempt to curb the narrative-driven product launches during the bull cycles? Is that the aim here?
So, I think it's an attempt to simplify, because finally, themes can be themes. Anything can really be a theme. But the idea is to make sure that if one is launching a thematic fund, and there's nothing wrong with not launching thematic funds, I have them, the industry has great thematic funds. It is something new that you're bringing to market. It's not a copy of something else that you have. So I think the spirit is extremely well intended on thematic launches. Too many funds from any AMC or from multiple AMCs, especially now so many AMCs, also makes things extremely confusing for the consumer. So I think it's an attempt to simplify the number of options for the consumer and also force asset management companies to say if you're putting out something new, is it truly distinct from the basket you already have?
Got it. The introduction of sectoral debt funds with 80% in AA plus, and this I want to and above, right? Do you think is kind of encouraging credit segregation to prevent another credit event spillover? Do you think that's the aim here?
I think it gives you more categories in debt, although if you were to ask me my honest opinion on this, beyond liquid and money market, I think post credit crisis, I don't think you've seen any growth in fixed income category, particularly after the change in taxation. So while it's well and good that we have a few more categories, how much these categories will be structurally used, I'm not sure. And I think even with the fact that we have more categories finally, given the liquidity of credit markets in India and the fact that you run daily liquidity open-ended structures, is this suitable? Is there, an ALM comfort here? I think that time will tell, and is there investor demand? So I think on this time will tell.
Understood. For hybrid funds, they are now allowing exposure to InvITs. There is exposure to ETCDs, also gold and silver ETFs as well. Do you think this is more towards multi-asset standardization? And I think it will make it more dynamic?
I think this one is particularly fabulous because historically for two reasons. One is historically, if you wanted real ETCD exposure, you only had the multi-asset category really to do the use of gold and silver. And it's not really fair that one category is the only one where you can take commodity instruments. I think bullion now is a very, very mainstream asset class. So the ability to put it into multiple hybrid funds basically means that everything is kind of a multi-asset fund in nature. I think the restriction on gold and silver, the flexibility on gold and silver is not just for one category, it's for the whole hybrid category. There's also, an interesting element of bullion or commodity-based arbitrage that can be explored in many of the hybrid fund categories. I think REIT and InvIT is a class that is growing. The government has talked about it, the regulator has talked about it. And I think this class really lends itself well to hybrid funds because REIT in itself is a hybrid instrument. So all of us already use them given the limits in our hybrid funds, but now we have a little more flexibility.
Got it. They've also introduced life cycle funds with fixed glide paths. Now, when I was trying to understand this from a lot of people, there were mixed reviews. I want to understand your viewpoint here. How are you viewing this as a product and what are the pros and cons that you're seeing?
Our view is not mixed. I think our view is clearly positive. We've been talking for a number of years about the introduction of this kind of category. We already had target maturity funds, which we started at Edelweiss MF, so why not target date funds? I do think retirement is one of the largest goals in India. And beyond retirement, I think life cycle funds now focus on goal-oriented investing. So many investors that I meet say, I want to invest, when do I redeem? And I think we have to, as a nation, orient investors towards more goal-driven investing. So with these 5-year, 10-year, 15-year, 20-year funds, investors can pick a time horizon based on their goal, and the fund will automatically rebalance your asset allocation from equity-heavy down to fixed income heavy. Say you want to educate a child in college 10 years later, you can pick a 10-year life cycle fund, start your goal very aggressively, and as that college education comes closer, the life cycle fund will be conservative, and all of this will happen in a tax efficient way without consumers needing to worry about rebalancing. So I think this is a great category. It really orients us towards goal-driven investing.
But the other side of argument for life cycle funds is that the idea of lock-in for this fund, right? The whole idea about mutual funds is with regards to liquidity. And secondly, these I believe would tend to be slightly more expensive. So how do you differentiate this from, the other fixed asset classes?
So I would say two things. One, I don't think they've imposed lock-in. They have said exit load. Now, exit load is actually a very, very good thing. And I think they've only said 3-year exit load. Anyway, if someone is an equity investor, they should be talking 3 years, 5 years, ideally 7 years. So I am actually, and nobody is saying these are closed-ended funds, so people can remove money. But here we are talking about someone who's investing for 10, 15 years, and we just want to make sure that there's a little bit of cushioning at the beginning so that they give the corpus that time to grow because equities can be volatile over 3 years. We all know that. As far as expenses, I don't think the expense structure here is going to be different from a regular equity or hybrid fund. I'm sure it's going to fall into the current equity or hybrid caps, and as these funds scale with PER, the size is going to come down. So I don't think it's going to be more expensive than a regular equity and hybrid fund. And given the features and the fact that you save so much in terms of taxation on rebalancing, I think this ends up being very good for a consumer.
Understood. Okay. Got your point on that, Radhika. For foreign securities, they've said that they'll not be treating this as a separate asset class. What is SEBI exactly trying to signal here? I mean, what is it that they want to, kind of try to do here?
I assume that line is in the context of multi-asset funds or funds where they're saying you need to have at least 3 asset classes present. Now, one argument could be my asset classes are domestic equity, domestic fixed income, and foreign equity. SEBI is saying here, no. Foreign equity or domestic equity, you're still equity. So if you need a third asset class, that has to actually logically be commodities. So I think it's a small point to signal that. Anyway, by the way, the foreign limits for mutual funds have been closed for a long time because of RBI restrictions.
Got it. One last question to you, Radhika. If you were to design the next core category under this framework, what would you see as the biggest structural opportunities? Is it life cycle funds, sectoral debt, or disciplined hybrids?
Life cycle.
All right, Radhika, thank you so much for taking out the time and helping us understand this particular circular and helping us decode that. Thank you so much.
Thank you.